Hello and welcome to this Trades and Tutorials video. This is Jeff Bish, president of MarketGauge.com, and in this video I'm going to take a look at two topics or tactics that I think could help your trading right now, and in fact they were exemplified by today's somewhat crazy market action. Now the first of which is going to have to do with a position change that one of our automated trading models made, and I want to show you kind of why you could have seen this coming, how you might be able to profit from it going in the future. And the second one is round numbers and how important round numbers were today in a big low in the market. All right, so but before I do, I want to make sure that if you're just finding us on YouTube, please subscribe and like our channel. And if you're finding us on Facebook, please like us and do the same. And know that you can find more videos like this at marketgauge.com/tutorials. All right, first, I don't usually reveal publicly or for free when our automated trading models make changes, but I thought it was really interesting and really brought to my attention that one of our models, the trades ETFs, and in fact, I am going to be doing a webinar on this model or one of the models tonight, and I'll put a link down below the video if you're interested in seeing how the model works. Crushes the market. We'll show you how it happens. And essentially, it uses ETFs to do it. So one of the switches was that it switched from being long XLF, all right, the financials. Now, it's been long XLF since the election, but maybe even before the election. So it really nailed XLF at the right time. But you might think, why now? Why is it getting out of XLF? And in fact, what it's switching to is XHB. Now, this brings to light that it is just so important that you follow what the leading sectors are. And I'm going to show you why that was important today during a pretty substantial sell-off that so far has come back. And I want to just focus on the fact that this table, which is free for anyone who comes to Blog and Free Tools on our site, Little Big View, Sector Summary, and this table tells you what the leading sectors are. But leading sectors is important to define. So leading sectors, as we define it in this table, is based on a 6-month rate of change. Now, our model that's making the automated trading decisions isn't based on 6-month change exactly. We've got our own proprietary trend strength indicator. But that trend strength indicator is based on this concept that longer term momentum combined with some shorter term momentum is a great indicator for persistent trends. In other words, trends that are going to continue. So when we switch from an XLF to an XHB, we expect that XHB is going to continue to trend for potentially quite some time. Now, obviously you don't have all that in this free table, but what you can do with this free table is make sure you're paying attention to the industry groups that lead this table, especially if you've got strong 6-month change. Now, even without the benefit of our model, you can see that XLF, while it is in the top on a 6-month basis, year to date has gotten, relatively speaking, pretty weak, almost down for the year. Over the last 3 months, really hasn't done much. So it has, just by looking at this table, has stalled out. And not only that, it's in a warning phase, right? So if you don't know what warning phases or you don't know what phases are, you can find more about that in the help section up here. But clearly, if you know nothing about phases, warning certainly is not as good as bullish. And you've got XHB, SMH, as bullish up ahead. You've got technology as bullish. You can see warning kind of sticks out. So if you're paying attention to this table, you know where you should be in terms of looking for ideas, either to trade the individual ETF or stocks within it. Now, let's just take note of what's on top here. You've got XHB, SMH, XLF, XLK, right? Now let's take a look at today's price action. All right, so this is my market watch table, but I'm going to use these 4 charts to illustrate a point here. And that point is that the SPYs, which are consolidating or have been consolidating for about 4 days, broke down today. Now they don't look that bad now because they've come all the way back. But when it broke down through this magenta line, which is the 10-day moving average, but more importantly, this key swing number of 239, they were breaking down through 4 days worth of support, a big support level. Now, if you want to be long, you want to be bullish, and you're only trading the SPYs, you're kind of stuck with wondering whether or not this is a major breakdown. Now, in the Qs over here on the right, we didn't have the same level of consolidation, and as a result, the pullback just came back down to the 10-day moving average. It wasn't as clear that it was going to be a major breakdown. In the IWMs, however, it was looking pretty dicey down here near the low of the range, right? So in this environment, if you're just looking at the overall market, you are likely to kind of get influenced by a lot of well, let's just say negative groups pulling down the stronger groups. All right. Now, what am I getting at? If you were focused on what the strong groups were doing as the market was selling off today, look what you would have found. The first one on our list was XHB. Okay. So if you were looking at having a stop that was the low of a recent major support level in the SPYs, you get stopped out, right? In the XHB, that support level is down here, right? So we took out 1, 2, third day held, all right? It's held up much better. If we take a look at the other top of the list item, SMH, down here, not even close. All right, so this is one of the strongest groups and had one of the strongest performances today. So you shouldn't have been spooked out with SMH. And if we take a look at XLK, as you can imagine, technology, because it's similar to the Qs, that too not as spooked out. All right, now if we take a look at XLF, you can see that this one looks much weaker here, and in fact broke down through its major support level. So XHB stronger. XLF, you can see warning phase means it's below the 50-day moving average, which is this blue line. So from this table, you can be putting yourself in the right place to look. Now, the other thing to do with this table is to take a longer term approach, longer term view. So let's take a look at just the XHBs, the home builders, versus the XLFs. And I just want to point something out. It doesn't always work this way, but the model, as I was talking about before, switching, if you look at XHBs coming right up against a big potential breakout area. So if XHBs can break out here, this is a major breakout. Now, our model that's making this switch is not looking at charts. It's not trying to figure out that it's a breakout. But if you put a couple of things together, and in this case, if you don't have the model, you have the 6-month change chart. And keep an eye on these weekly charts of the leading sectors on that chart, because XLFs were a leader in here, all right, with a big breakout. When I said that we were nailing, in fact, XLFs were a leader even in here. So the 6-month rate of change has been very often a nice early indication that big move is coming. Now, this does not mean that XLFs can't continue to move higher, but if you ask me, looking at a weekly chart, looking for a kind of new, fresh idea, XHB breaking out over 38 is a much fresher idea than XLF struggling here at 24. So not to say I've totally given up on XLFs. I certainly haven't, but I must say I'm encouraged to see XHB continuing to move higher. And all of this, you could be led to it by simply paying attention to this table. All right. So with that, if you're interested in the model, as I said, the more advanced and precise and completely automated way to do this kind of thing, I'll I'll put a link down below. Click on it, attend the webinar. Now, one other thing that I wanted to show you in this quick video was the round number concept. So if I go back to the daily charts, and this isn't just for indexes, I use this for stocks as well, but let's just take a look at, use it on the indexes today. When the markets are selling off, or you need to find a stop, one of the things you really should consider is the powerful effect of round numbers. So when I say round numbers, in this case, I mean big round numbers. So in the case of the SPYs, it would be 232, 233, 234. In the Dow, 208, 209. Right? In the Qs, 138. Right? You get the idea. So if we take a look at the SPYs today as they're falling, it would be easy for you to just kind of look at these levels here, these lows, 237.70, and say, okay, that's the support. But very often the support will come in really close to the round number. And today, that's exactly what happened. The low, 238.13. Right? In the Dow, 208.10. In the IWMs, 137, yeah, 136, right? 136.98. All right, now I happen to be long IWMs and long SPYs and wasn't really happy about the sell-off, but as it kept getting kind of worse and worse during the day, I said, all right, my uncle point is under the round number, under the round number. And look, it doesn't always work, but it certainly did save me, at least for today, save another day. But it happens so frequently. Look at your stocks, pay attention to those round numbers. And when we say round number, when I say the round number, it's an area around the number. So don't put your stop at, for example, 136.99. Right? You need to give it more room based on the normal volatility of the stock. And we talk about that. In fact, I talk about that normal volatility all the time in our courses, sometimes in our webinars. But for now, pay attention to those round numbers, pay attention to those leading sectors, not only for trading ideas, but to really give you a sense of whether or not the whole market is in trouble. Like I said, today, those leading sectors were not breaking down in the same way that the overall market looked like it could have been if you were just focused on the Dow or the S&P or the IWM. Hope that helps. I'll see you in the next video.